Imagine for a moment putting aside just $100 a month. It's a relatively small amount, isn't it? In fact, many people spend more than that without even thinking about it. But what if I told you that by simply setting aside $100 every month, you could amass $1 million over time? It might sound like a fantasy, but in reality, it's a feasible goal, one that anyone can reach with patience, consistency, and a bit of strategy. Let's dive into how this simple monthly habit can grow into an extraordinary sum. The first thing to understand is the power of compound interest. Compound interest is often referred to as the eighth wonder of the world. It's the process where the money you earn on your savings starts earning interest itself, creating a snowball effect that can grow your wealth over time. When you invest a consistent amount of money, say $100 a month, and let it grow with compounding interest, your savings don't just increase linearly, they start growing exponentially. Initially, you might not notice much of a difference, but as the years go by, the growth becomes more noticeable. This is the beauty of long-term investing, where the earlier you start, the more powerful your returns become. Let's break this down further by looking at the numbers. If you set aside $100 each month and invested in something like the stock market, historically, the average annual return of the US stock market is around 7 to 10% after inflation. With a return of 8% per year, for instance, your investment grows steadily over time. At first glance, putting away $100 a month doesn't seem like much. Over the course of a year, that's only $1,200. But here's where the magic happens. The longer your money stays invested, the more it compounds and the more it grows. After 30 years of consistently investing $100 a month at an 8% annual return, you'd have accumulated approximately one. Now that's certainly a good amount, but we're still far from the $1 million mark. Here's the thing. It's not just about the amount you're contributing each month, but also about the length of time that you leave your money invested. The longer your investment has to grow, the larger the final amount will be. So, let's assume you continue investing that same $100 each month, but you stretch it out over 40 years. At the same 8% annual return, your $100 a month investment would grow to around still a long way from $1 million, but this gives us a clearer picture of how time and consistent contributions make all the difference. Let's turn the dial one more time and extend the investment period to 50 years. With 50 years of consistent $100 monthly contributions and 8% returns, the result is a staggering $1.1 million. This is the power of time combined with the magic of compound interest. In this scenario, even though you're only putting in $100 a month, the growth over 5 decades is immense. The growth accelerates as the years pass. So, what's the key takeaway here? Time, patience, and consistency are the critical ingredients in transforming $100 a month into $1 million. If you can commit to the habit of saving regularly, even a small amount, and let it grow over time, you can reach significant financial milestones. The earlier you start, the more time you give your money to grow. The longer you stay invested, the more it compounds. Of course, investing isn't a one-size-fits-all proposition. There are a variety of options available for growing your wealth. Stocks, bonds, real estate, and other vehicles each come with their own risks and rewards. But the principle remains the same. The more time your money has to grow, the more likely it is to become a small fortune. When you think about it, $100 a month is an amount that most people can afford, even on a modest budget. It's less than a couple of dinners out or a weekend trip. Yet, if you're disciplined about consistently putting it away, you could be looking at a comfortable retirement or the ability to achieve other financial goals. But the real question is, why don't more people take advantage of this opportunity? The answer often comes down to a lack of awareness or understanding of how powerful compound interest can be. Many people might think that $100 a month won't make a dent in their financial situation, especially when they're focused on immediate financial pressures. But the reality is that consistency pays off over time. Small amounts of money add up, and when you take advantage of compound growth, they add up much faster than you think. Another reason people hesitate to invest is the fear of risk. Stock markets, real estate, and other investments can feel uncertain or volatile. But if you commit to a long-term strategy, you can ride out those fluctuations and benefit from the overall upward trajectory of the market. Investing isn't about timing the market, it's about time in the market. Even with downturns along the way, the general tendency of well-chosen investments is to increase in value over the long run. This is why it's important to start as early as possible, even if the amount you're contributing is small. The time factor is the most important variable. So whether you're saving for a home, your children's education, or your retirement, the principles are the same. Start now, invest regularly, and be patient. Let's talk briefly about how to make this process even more effective. One of the most straightforward ways to set up your $100 monthly investment is through automatic transfers. By setting up an automatic investment plan, you ensure that the money is invested every month without fail. This removes the temptation to spend it on something else, and it takes the emotional aspect of investing out of the equation. Good, many people also choose to invest their money in low-cost index funds, which are a collection of stocks designed to track the overall market. These funds tend to offer good long-term returns while also minimizing individual stock risks. For a consistent return that doesn't require a lot of monitoring, index funds are a popular choice. If you're looking for an even more hands-off approach, robo-advisors have become an increasingly popular option. These digital platforms use algorithms to automatically manage your investments, adjusting the portfolio based on your risk tolerance and goals. The best part, you don't need to have any in-depth knowledge of investing to use them. But beyond the financial strategies, what does this approach teach us on a deeper level? It teaches us the value of discipline and delayed gratification. In a world where instant gratification is often prioritized, the idea of putting away $100 each month with a promise of long-term gain requires patience. You're choosing to defer immediate rewards for a greater payoff in the future. This lesson goes beyond just money. It's about investing in yourself, your future, and your dreams. And the earlier you start, the easier it is to build a habit of consistent growth. In conclusion, the journey from $100 a month to $1 million is not only possible, it's practical. It's about harnessing the power of compound interest, sticking with a strategy, and giving it time. Whether you're looking to retire early, buy a home, or simply secure a better financial future, $100 a month is a small but powerful starting point. So let's stop thinking of $100 as a small, insignificant amount. Instead, let's see it for what it truly is: the first step toward building significant wealth. With consistency and patience, that $100 a month can grow into $1 million future. The power of compound interest is one of the most significant factors when it comes to building wealth. Essentially, compound interest is the process where the money you earn on your investment begins to earn interest itself. This snowball effect means that over time, your earnings don't just grow at a linear rate, they grow exponentially. The more time your money is invested, the more it multiplies as each year's gains are added to the principal and also earn interest in the following years. For example, when you invest $100 a month, you're not just earning interest on your initial $100, you're also earning interest on the interest generated by those contributions, creating a cycle of growth. At first, it may seem like a slow process, especially when the contributions are small. However, the magic of compound interest is that it accelerates as time passes. In the early years, the growth may seem insignificant, but over decades, the accumulated interest begins to outweigh the original contributions. The key to fully leveraging compound interest is time. The longer you leave your money to grow, the more pronounced the effects become. Starting early amplifies this effect even further. For instance, if you start investing $100 a month at age 20, you'll have many more years of compounding than if you start at 40, leading to a much larger amount over time. This principle is why even small, consistent investments can lead to substantial wealth. A modest $100 monthly contribution might not seem like much in the short term, but over decades it can snowball into a large sum, all because of the power of compounding. Consistency and patience are two of the most important qualities when it comes to building wealth through investing. While it might be tempting to try to time the market or make large sporadic investments, the true path to long-term financial growth is rooted in regular, steady contribution. By committing to contribute $100 every month, regardless of market conditions, you establish a habit of saving and investing that compounds over time. The key is regularity, sticking with your plan, even when markets are volatile or the returns don't seem immediate. One of the most powerful aspects of investing is that the more time you allow your money to grow, the more potential it has to accumulate. This is why starting early and being consistent with your investments is so important. If you contribute a small amount each month for 30, 40, or even 50 years, the power of compound interest begins to work in your favor. Even modest monthly contributions can add up to a substantial sum over decades. especially if you don't interrupt the process or try to predict the market's short-term fluctuations. A common mistake many people make is trying to time the market, buying and selling based on short-term predictions, hoping to catch a hot stock or avoid a downturn. However, this approach can lead to missed opportunities and unnecessary stress. Instead, staying committed to consistent monthly investments ensures that you are always in the market, regardless of its ups and downs. The stock market has historically shown growth over the long term, and by allowing your investments to stay put and grow naturally, you maximize the potential for wealth accumulation. Ultimately, time is the most valuable resource when it comes to investing. The longer your money is invested, the greater the potential for growth, regardless of the amount you contribute. Consistency and patience give you the ability to reach financial goals that might otherwise seem out of reach. One of the most effective ways to make consistent investing easier and more efficient is by setting up automatic contributions. By automating your monthly investment, you remove the emotional aspect of investing, making it much easier to stick to your plan. Instead of waiting until you feel like investing, automatic contributions ensure that the money is put aside each month without fail. This strategy also prevents the temptation to spend that money elsewhere, allowing you to stay disciplined and focused on your long-term goals. For instance, you could have $100 automatically deducted from your checking account and invested in a pre-chosen fund or portfolio every month, creating a seamless, hands-off process that ensures your wealth-building strategy stays on track. Another key benefit of automation is that it helps you stay consistent, regardless of market conditions. During market downturns, it can be easy to panic and stop investing, especially if you feel uncertain or fear losses. However, when contributions are automatic, you keep investing through both good times and bad. This is important because it enables you to take advantage of dollar cost averaging. This strategy involves investing the same amount every month, which means you buy more shares when prices are lower and fewer shares when prices are higher, smoothing out the impact of market fluctuations over time. Low-cost investment options like index funds or exchange-traded funds, ETFs, are excellent choices for those looking to keep fees minimal while still achieving solid long-term returns. These funds track the performance of an entire market index, such as the S&P 500, which gives you exposure to a broad range of stocks. Since index funds don't require active management, they typically have lower fees compared to actively managed funds, which means more of your money stays invested and working for you. Robo-advisors, which are automated platforms that build and manage a portfolio based on your risk tolerance and goals, are another great tool. They offer a low-cost, hands-off approach to investing, often with minimal fees, making them an attractive option for those who want to grow their $100 monthly investment passively. By combining automatic investments with low-cost, diversified options like index funds or robo-advisors, you create a streamlined, efficient investment strategy that grows steadily over time. This approach not only removes the guesswork and emotional decision-making from the process, but also ensures that your money continues working for you even when you're not actively thinking about it.